Hey everybody, this is David Skarica. So a quick stock chart of the day here today. We're going to look at interest rates just quickly because I think something interesting has happened. So today the GDP report came out stronger than expected. So a lot of people acted like it was, like maybe hawkish for the Fed, blah, blah, blah. But I actually think it increasingly looks like interest rates, especially on the short end, have now topped. And if we go look at this chart here, you can see the rate of increase has really slowed down. Really, if we go look at them, this is the 3-month Treasury T-bill, so basically the 90-day T-bill, and we can see that really since June, rates have not gone much on the 90-day T-bill, and it just looks like to me we're topping out. And usually, if you go look at again, you look back at 2006, 2007, 2000, you can kind of go into this like 3, 6, maybe even 12-month period where rates kind of top out on the short end, and then they go down when the Fed starts cutting. So it looks to me like we're increasingly going to top out here. And if we go look at the long bond today, rates were down about 10 basis points. So maybe we've even topped out at around 5% on the long bond. Even though there's more debt being issued, deficits are going to be bigger in recessions and slowdowns. I think most people realize that this last quarter, is July, August, September. So a lot had to do with the summer travel season. This is the first year that really everything was totally open. There was still a lot of COVID restrictions in some places last year. So, and obviously U.S. actually America wasn't allowing people in who weren't unvaccinated till May of 2022, or May of this year, in May of 2023. So like you're looking at like, this is the first time people could travel to the U.S. without any restrictions, et cetera, et cetera. And I can tell you something. And when I traveled to Europe last year in 2022, I found it a bigger pain in the ass travel because I just had to stop through the States for like a day on my way back to Europe. And I found that to be a bigger pain in the butt than actually being in Europe. So those travel restrictions and those COVID restrictions did have an effect, right? So I don't want to rant about that though. So I just want to show you that it looks to me like even though this GDP number came in stronger, bond yields were down a bit, et cetera, et cetera. So the stock market did go down. We'll talk about more about that this weekend. So this is the Fed funds rate. We've talked about this in the past. So basically, there's 100% chance that nothing gets happened. This is right where we are right now. That's why you see that 530. So we go out to January. And you can see there's only like a 28% chance of another rate hike. There's like 2% chance that they do a half point and 26% chance that they do. And this is down. This was like 40% just a little while ago. We go to March, then it really drops. You can see even there's a little chance of a rate cut by March. Let's go to the end of the July. So July right now, we're like, there's basically like a 75% chance that there will be, a quarter point cut, and about a 50-50 chance there'll be 2 quarter point cuts or a half point cut, which isn't very much. So, but it looks like then if we go out a year, these things don't get that accurate going a year out, but let's just look at it and you can see here, like there's basically an over 80% chance that we'd be down, 50 basis points, by the end of the year next year. And about almost 60% that will be down 75 basis points, which again is not huge considering how much we went down. So it's kind of like that higher for longer thing going on. But I think for the sake of what we're talking about here, and this is really good for gold because gold tends to go up. You're looking at 80% chance in December that they're going to do nothing and only 20% that they'll raise. It does look like rates now have finally topped out in the short term. So it looks like this rate hike cycle is finally over. And you can see here, no change, 80% hike, 19.8%. Let's go out to December. So yeah, there is a 97% chance that they will have cut rates, by the end of December, et cetera, et cetera. You can see it's 61% chance by June. So it does look like they will cut rates maybe a couple times next year. We're in an election year. Well, obviously, they obviously tend to do that sort of thing. In 2004, after a whole bunch of rate cuts, in 2002, 2003, they didn't do anything, but rates were already low. They didn't start raising to 2005. Again, after the election year, 2008, also obviously the financial crisis. 2012, they kept rates at 0. 2016, after they raised one time in 2015, they didn't raise rates in 2016. And then 2020, obviously they cut rates to 0 because of COVID. So again, in these in election, in 2000 was an election year, they did raise a couple times early on, but we were kind of in the top of this stock market bubble. In 96, they didn't, in 92, we're both loosening years as well. So same in 88. So basically these years tend to be, loosening years in election years. So but like the loosening is going to be very, very slim. But I think the most important thing now is, even with this hot GDP number, we've actually gone from a 60% chance of a 40% chance of a rate hike, and now we're down to like 20 for the next couple months here, 20 to 30. So that tells me it's probably over. Like, it would have to take a huge reversal in the stock market, maybe combined with a rally in oil in the fourth quarter to 100 for maybe them to do a January hike. And that January hike would probably be the last one at that point. So I mean, that's the only thing that can kind of do it at this point. So that's it. I just wanted to show you interest rates here. It does look increasingly like your interest rates have topped. And like, let's go look at the last couple cycles just to finish off here. We're going to go back 20 years. And you can see, again, this is 2006, 2007. And then you can see kind of that flattening on 2018, 2019. And actually, if I went back to, because I want to show you the 2000 thing as well. Let's go back to 1997. And we really can't see it. Let's go back. Just look at 2000. Yeah, you can see everything flattening kind of. Actually, it kind of looks, again, very similar. And I've talked about this being similar to 2000, where the dot-com bubble is bursting, blah, 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 the Magnificent Seven or whatever they call them now. Written by Sam Spence, by the way, who I became friends with at the end of his life. He used to write all the films for NFL films. If actually anyone sends me an email, I will send you an audio of the Magnificent 11. That's actually what Sam Spence wrote. And my friend redid a modern version of it. It's fantastic. So anyhow, I just think that we're kind of in that period now. You can see it kind of topping out, similar to like the 2000 here, similar to here and here. And the question is, how long is it? Is it 3 months? We're already a couple months into it. Is it 6 months? Is it 9 months? Is it 12 months before the rate cuts begin? And I still think we're in the secular bear market for bonds. But yeah, you could, after going up 530 basis points, you could go down, you take half those back, you're going to be around 275, so that could happen, or at least like to 300 or, 350, so that could definitely happen here. But it does look like now to me that these interest rate hikes are essentially finished. And I've talked about this in the past. That's very good for gold. That's very good for precious metals, because whenever the Fed, they don't have to cut rates. Usually when they go from the tightening cycle into not tightening, precious metals do very, very well. And then when they go into loosening, they do even better. So I'm going to leave it at that. I hope everybody had a good day and enjoy the football game tonight. If you are a football fan, the Bills are kind of my second team because I'm from Hamilton, Ontario, which is about a 45-minute drive from Buffalo. And the Bills have kind of disappointed this year. I thought they would be better. But anyhow, everybody take care, and hope you enjoyed this video on interest rates.